Welcome back. U.S.-China relations. Another round of talks between the U.S. and China will be held next week on the 31st. China reporting its weakest growth, economic growth, since 1990 this week. And many investors are worrying that this slowdown will ripple across the world. Morgan Stanley China CEO Wei Christensen was with us yesterday, weighing in on the slowdown on this program.
I think China's slowdown is short-term, and it's largely driven by the leveraging initiative of the government and also the trade tension and weakened sentiment. But I think if you look at this government reaction to the slowdown, it's very interesting. In the past, they will take the easy way out, and by resorting to these credit-driven stimulus tools and to boost the economy. But now they're more careful because they want to preserve the good result of the deleveraging and the financial sector cleanup.
And joining me right now is Harvard professor, leading economist, Ken Rogoff. Ken, it's good to see you.
Pleasure to be here.
Thanks so much for joining us. So what's your reaction to what's going on in China and its implication on the U.S.?
Well, I think we're seeing a longer-term growth slowdown. I don't agree that it's just short-term and they'll do some stimulus and it's all over. It's been going on for 5 years in a way, but I think it's accelerating as they try to centralize the government and have an innovative, decentralized economy. They're amazing in China, but it doesn't work. I think we're seeing a productivity slowdown, not something you can just offset with demand.
Will it hit the United States?
I mean, it hit Europe more than the United States, I think that's for sure. But it could be worse than you think. I mean, because if Asia slows down and Europe slows down, that hits our companies, our profits. And I'm not positive that this one's going to make interest rates go down because it's a productivity slowdown, not so much a demand shock.
So what's your sense of the United States right now? A lot of conversation here in Davos about slowdown, the potential of a recession. Where are you on all of this?
Well, I mean, a recession's a 15–20% chance in any random year, and you go out 2 years, you get 30 to 40%.
Maybe
for
2020,
sure.
Yeah, 30%.
Yeah, but I mean, I don't think it's particularly acute. I mean, we're clearly having a gentle slowdown. I mean, the shutdown continues another 5 months. All bets are off. It's like having a natural disaster every week for a long time. But I think the fundamentals are still solid. You know, I think the fiscal stimulus was overrated as how much of our growth was coming of that and how much was organic. So I tend to be a little north of the Fed's estimates on growth. Again, there's a lot of craziness, and who knows where it will go.
Are you surprised at the Fed's action in terms of this recent pivot, basically telling us that, look, we're going to watch the data and we may or may not do the rate hikes that people are expecting, and we may or may not unwind the balance sheet as expected?
Oh, I mean, I think they made a big mistake in December and said so at the time, not so much in raising rates. If you promise you're going to raise rates, you have to deliver. But they could have given a much more cautious assessment with the China slowdown, Europe slowdown, stock market turmoil.
So they missed it.
You know, they were overly confident in their forecasts, and after the last 10 years, I can't see why they would be.
Where do you see the growth in the U.S. right now? Industries or areas? Where's the growth?
Well, I mean, I think obviously health industry is something that's very strong no matter what goes on. You know, there's the old tech may not be booming, but the new tech is still coming. I live in Boston. Biotech is huge. And just, you know, conventional industries as well. I mean, I think it's fairly broad-based. We're not going to grow as fast as last year, but, you know, it still could be solid.
Love to hear the optimism. Ken, it's good to hear you and good to see you. Thanks so much.
My pleasure. Good to be here.
Thank you so much for joining us. Ken Rogoff.